On the wealth effect and how a decline in housing prices could impact the economy. We're joined in studio by City House Craig Alexander. Craig, thanks so much for joining us.
It's a pleasure.
Well, let's put this into context first. The CMHC actually did a presentation yesterday about the state of Canada's housing market, and they noted that a little more than 45% of the average Canadian's net worth is tied up in the value of their house. What does that number say to you? Is that too much? Is that too little? How does that compare with historical norms?
Well, what it really tells you is Canadians are very leveraged to real estate, and they always have been. I mean, when you look at household balance sheets, what you find is the single biggest asset they own is usually the value of their house. It's a big source of wealth for Canadians, and in the long run, it's paid off handsomely. If we look since 1999, home prices are up north of 150%. And as mentioned, this actually creates a positive effect on the economy because for every dollar your house goes up in value, households will go out and spend a few more cents. You know, the estimate might be, say, 5 cents. And what you find is the wealth effect on real estate is actually greater than the wealth effect on other financial assets. I think part of the reason for that is when people see their stock portfolio go up, they sort of intuitively know that there's a risk it could go down. And so what you find is the wealth effect on stocks is, you know, for every dollar you get maybe 2 or 3 cents of spending. But on houses, people feel more secure because home prices have risen over time, over the long haul. Dips that tend to be very temporary, and as a result, people feel secure. Well, of course, the problem is we've had such a good run in the housing market for such a long period of time. This then creates risks that, you know, there could be some overvaluation there, and if interest rates rise, you know, you could unwind that overvaluation, and then that would tip the positive wealth effect into a negative wealth effect.
I keep looking, though, for that catalyst that's going to take home prices lower, because he could have argued the same thing 5 years ago and missed out on tremendous house appreciation. So oil is something people talk about, but is that going to cool Vancouver, which is arguably, you know, running the hottest? So how does that play out? How do we get a cooling?
Well, I think this is where a lot of forecasters have gotten the housing predictions wrong. You know, there's been many forecasts saying, you know, next year you're going to see a correction in housing prices, and economic forecasters have been remarkably bad on the interest rate call. You know, the forecasting community keeps saying, you know, every 12 months from now the interest rates will be higher, and then they haven't been. And it does look like we're trapped in a low for long interest rate environment. You know, the recent economic data, even the data we got today on economic growth, basically tells us the bank's not going to be in a rush to raise interest rates. Economic growth in Canada is going to be quite modest. And as a consequence, you know, there's no real catalyst for a sudden change in behavior. Now, obviously, different parts of the country are having different experiences, and the commodity price correction, particularly oil, is having an impact. So Calgary is already having a housing price correction. What is interesting about what's happening in Calgary is it's relatively orderly, and I think part of the reason for that is home prices are only down a couple of percentage points year over year, and the reason for that is that employment in Alberta is still holding up better than you might have thought, given what happened to oil prices. Now, if employment weakens in Alberta, then I think you're going to see a bigger price decline in Calgary, but it's not going to be present in Vancouver or Toronto, where the markets are quite strong. And this is actually a characteristic of the Canadian real estate market. When we've had corrections in the past, they've been regional in nature. You haven't had a broad-based cross-the-country correction. But I actually think the risks of that would really go up if interest rates rose.
And so let's talk then about that path of normalized interest rates. What is your base case for what that looks like? And is that scenario going to cause a disorderly cooling of the housing market? Or can we withstand if in a period of 5 years we go from essentially 0 to, let's say, 3%?
Well, I think that if we take the communications that we're getting from the Bank of Canada, you look at the forecast for the amount of slack in the Canadian economy and the inflation risks, it basically would suggest the Bank of Canada probably is going to be on the sidelines for at least the next 12 to 18 months. And even then, when interest rates rise, I don't think the Bank of Canada is going to be pushing interest rates sharply higher because I think the inflation risks are still going to be low. I think a lot of forecasters that are expecting a cooling in the housing market in the coming year are really focused on the fact the Federal Reserve is going to raise interest rates, and when that happens, bond yields in the U.S. will go up. That'll push up bond yields in Canada, and that impacts our fixed mortgage rates. So if like 5-year bond yields go up half a point, you would expect 5-year fixed mortgage rates to go up by about half a point. But given how low interest rates are, you know, even if fixed mortgage rates went up by half a point, you know, I don't think that would create a real problem in the housing market because interest rates are still, in level terms, so incredibly low. I think really what it comes down to is when the Bank of Canada ultimately rebalances monetary policy, and this is looking probably beyond the next 2 years, that interest rates start to get normalized in a meaningful way, I think that's where the risks really go up because there is an imbalance. I do think you can make a pretty strong case that real estate in aggregate is probably overvalued in Canada by 10 to 15%, and it's not overvalued equally across the country. There's more risk in Vancouver and Toronto. So is there a risk of a correction down the road? Yeah, there is. Is there a catalyst for a correction in the next year or so? Probably the answer is no.
Does a 10 to 15%, pullback in home prices across the board spell catastrophe for the Canadian economy? At what level does a percentage correction mean we really have to be cautious about this for the Canadian economy?
So if we're fixated on what the impact of changing home prices is on the wealth effect, I think that the negative wealth effect of a housing correction would be relatively modest. So let's say you had a $300,000 home and prices go down 10%. So then you've lost $30,000. Well, 5% of that means that you're basically going to see a cut in spending of $1,500, but spread over 4 years, because that's the length of time it takes for these effects to work through.
Right.
The bigger issue is what causes the correction in the housing market. And if the answer is it's higher interest rates, I think the bigger risk to the economy isn't the negative wealth effect from housing. It's actually the fact that interest rates have gone up and now debt service costs have climbed and now consumers have less money for other things. And that's where I think you actually see more vulnerability. So I don't think that the wealth effect is what really the focus should be on. I think the real issue is household leverage. And then what happens when we get a normalization of interest rates? And what it tells us is the Bank of Canada is going to have to be very cautious about when they rebalance. Because the biggest problem is many Canadians, particularly young Canadians, think the mortgage rates we have today is normal, and they're anything but.
All right, you've given us a lot to think about. Thank you so much for joining us.
Thanks for having me, Amber.
It was Craig Alexander, Vice President of Economic Analysis at CD Howe Institute.